Okay, welcome. We're here in our November issue of the ETF Spotlight. Jessica and I here again today. Welcome, Jessica.
Welcome, thank you.
And what we thought we'd talk about today is the iShares US Preferred Stock. We'll give you the fact sheet on the website. The ticker is PFF, and I thought I'd have you, Jess, kick off about how this ETF works.
Sure. Well, I think it's important to start with looking at what is preferred stock. So this is an ETF that buys a basket of US preferred stock specifically. And when we look at the underlying instruments, preferred stock, they're a hybrid instrument. So they have some characteristics of debt and some characteristics of equity. So like debt, they typically pay a fixed coupon. They can have a duration, although most preferreds do not have a maturity. In the capital structure, for if a company is liquidating, they have priority over common stockholders,
right,
and they have priority when it comes to income payments. But it is equity, so there is also the potential for the stock to appreciate, typically based on the creditworthiness of the company, and you do have equity market exposure in
right,
investing in preferreds. We're using this particular ETF and preferreds as an asset class to complement our fixed income portfolio and to substitute for some of the core fixed income. So for our purposes, we're thinking of this more like debt for the debt features that this has.
Okay, so when we look at the ETF, and I'll just bring this up on the screen now, what's in it? And when I go down the page here, we can see a whole bunch of bank stocks. So can you just talk
That's correct.
to that? Yeah.
So preferreds, while in theory any company could issue preferred stock, preferreds are most commonly issued by financial companies. And this particular ETF is a US preferred ETF, which means it's buying almost exclusively US financials. You'll find a few non-US positions in here.
Yeah, I can see HSBC there at the
There's
second top.
HSBC, Barclays, so it's about 10% UK banks, most of, or all of which will have a presence in the US, and many of which are listed in the US as well as a dual listing. But when you're allocating to preferred stock and a preferred stock ETF, when you think about the sector exposure, what you're really doing is buying financial stocks.
Right.
And so the importance of the creditworthiness of banks and your confidence in the exposure to financial markets is important. So when you look at this position historically, it was launched, if you will, probably at an inopportune time. This position was first
It's like
issued in
nearly
the market in
8 years ago. Yeah.
Yeah, it effectively came out in mid-2007, around March 2007, which meant it had sort of just about a year before the global financial crisis came. And the global financial crisis was very specifically a banking crisis.
Yes.
And so purely based on sentiment, not because of necessarily defaults on these preferreds, but at points where Citigroup is trading below $1 a share, the value of this position dropped dramatically. It's why the since inception return is so low, is that 08-09 period in which consumers had very little confidence in financial stocks. Some of the issuers temporarily stopped paying their dividends
right,
on these positions. So you have a significant negative downturn. But beyond that period of that specific financial crisis, one of the things we like about preferreds is they're relatively uncorrelated both to debt and other equities, and on a relative basis, fairly stable. And on a recent allocation basis, one of the reasons that we bought this position now, or we are buying it now in our accounts, is that we feel confident in the health of U.S. financials. So we feel that the banking sector is probably stronger than it's ever been. We feel good about the underlying issues. And in an environment where fixed income yields are very low, fixed income markets are very challenging, and we expect rates to rise very slowly, this position is quite sensitive to interest rate risk, both going up and down. This position, assuming we're confident in the credit of the financials, we feel good about allocating here for the better yield.
So talking to that, we can see on the fact sheet that and I'll show people here, there's a 30-day SEC yield, which is 5.49%, and then further down here, there's the 12-month yield of 6.17%. So can you talk on those two things just for 30 seconds and why these companies are paying such high yields?
Sure. So the yield is a reflection of the credit risk that you're taking. So it's important to understand with preferred stock, you have less priority in the credit structure than bondholders.
Right.
So you are taking on more credit risk. As such, the issuer has to pay you a higher coupon for taking on that relative risk. In addition, many preferreds over the last year, 2 years, like bonds, they can be called. So if an issuer has a preferred out that is paying 7% and interest rates are low, banking sentiment is improving, that issuer can probably call those 7% preferreds and issue 6% preferreds or 5% preferreds. And that's been happening. We think we're near the end of that cycle, if not at the end, which is part of why we've allocated to this position now. But this position, you saw a definite wobble here around the taper tantrum previously, where investors were worried about interest rate hikes and potentially quick interest rate hikes. But now expecting a fairly slow and stable rate increase, and going into a rising rate environment, most of the preferreds we believe that are going to be called have been called, and we expect the yield to be fairly stable.
Right. I mean, there's some pretty decent yields, and this is the thing, you and I are seeing with these portfolios, and I'm seeing there with some Australian clients as pensioners, they're getting, less than 1% in a 12-month term deposit. They see 5 or 6% dividend, and they're diving into it, which is driving the price up. But that's no good if you're getting it on a falling value.
Well, one of the attractions of preferred stocks is they do have less risk and less volatility than common stocks. And for many investors, moving to an all-equity portfolio just isn't palatable, especially if you look at the market movement we saw as a result of the rumble in China in August. You saw a significant correction across many markets, even large-cap blue-chip stable markets. And all-equity portfolios and the volatility that goes along with those isn't suitable for many investors. At the same time, many people who are in a income-generating mode, they're retired or they're nearing retirement, are struggling because traditional fixed income that used to at least give them 5 to 6% now gives them 2 to 3. So preferreds for investors who understand the risk and the allocation in a market where we feel confident about the credit worthiness of bank stocks are an alternative that provides an attractive yield with also attractive risk-adjusted return.
And, in this current environment, we're seeing it in Australia. The banks just last week raised interest rates, so interest rates look to be universally on the way up. Thoughts on that and how that would play out with this ETF?
I think on a global perspective, I actually think you'll see more quantitative easing in Europe. I think you'll potentially see more rate cuts in China. I do think the US is moving towards, in fact, I hope the US is moving towards a rising rate environment and a more normal interest rate environment. But all the evidence suggests that that's going to be very slow and gradual. You wouldn't allocate to preferreds if you expected rapid rate hikes, because these are duration, because most preferred stocks don't have duration. They're quite sensitive to interest rate movements in terms of the price of the stock itself.
Just elaborate on duration for a little bit.
So duration is, when you look at fixed income, one of the big issues everybody talks about is duration risk. Well, all that really means is, when does that position mature? So how long am I guaranteed to get the rate I'm getting?
Yeah.
And if you've got a long duration issue, so let's say you buy 30-year treasuries and interest rates move 100 basis points or 1%. It's reasonable to expect that the value of your treasury in the secondary market for that 30-year T-bill could fall 10%, because to get another investor to buy your current 30-year T-bill paying the rate that was when it was issued, you have to offer them a discount, because otherwise they're going to go buy a newly issued bond that's paying more. So when rates go up, new bonds pay more, existing issues are less marketable and they fall in value.
Right.
Now that impact is muted if rate increases are very slow and gradual. It's pronounced when you see significant rate hikes in a short period of time. All of the evidence suggests the U.S. is going to be very slow and cautious and dovish in their rate hikes over the next probably 2 to 3 years.
So it's not going to be a rapid jump of 1-2%.
There's nothing to suggest a rapid rate environment. Now, for fixed income investors, to some extent, that's a little bit frustrating. They've been waiting for years now, getting very low yields. I think even in our own client base, we have clients who would prefer to have an entirely fixed income portfolio, but they can't afford to do so in such a low rate environment. And we don't see that improving dramatically, certainly in the next 12 months. That's probably a 2 to 3 year process to get back to a more normal rate environment. In a market where, as you mentioned earlier, many stock prices have already been driven up by the demand for dividends. And so in looking at that asset allocation, preferred stocks make sense as a place to reduce risk and still get a reasonable yield.
Okay. Well, time's flying by, as it always does, too quickly in these segments. One final thing is, the performance is the compelling thing that we're looking at in terms of expectations over the next 12, 18 months, 3 years in this stock. What are your thoughts on that?
In terms of performance, I expect the market price of preferreds that are in the markets now, and as a result, this ETF, to be relatively stable. Even with the movement in China, even with some of the decline in high yield bonds, other interest related concerns, prices recently here have actually been quite stable, and I expect that to continue. In a rising rate environment, you're not going to get any or very little appreciation on the equity side of things here. We're really buying this for that yield. We're buying this for that 5 to 6% coupon. I think over the next 2 years, it's probably going to be closer to 5. Eventually picking up new issues as rates improve. But for what we view as very low capital risk, stable, large, primarily U.S. financial institutions, we view that as a pretty good return for the risk that we're taking, and better than we can get in many other areas of the fixed income market.
So, if we were here in the GFC where Citibank was $55 down to $1, you would have to say, blood on the streets, this is a good time to buy. We should have some good, uptick in the next 3 years. But really, we're trying to manage expectations down to say, low single digit, maybe high single digit, low double digit type returns on this stock.
In this particular position, I think your return is primarily going to be the yield. So it's important to think of this as that 5 to 6%.
Not so much capital
because
appreciation.
we're not going to see capital appreciation here. We're not buying it for that. And quite frankly, if we were in the global financial crisis and you wanted to profit from that, you would have bought the common stock, not the preferred, because it appreciated substantially more.
Excellent.
We're buying this for the income. I think it's very unlikely you get more than 5 to 6% out of this. But in this interest rate environment, for a relatively low volatility position with credit risk that we feel like is quite good, I'm quite happy with that in this environment.
Excellent. Well, thanks, Jess. Another good addition. We'll put this one out there in 1st November. So once people watch this one, we'll have the next one coming through in December, and we'll talk to you some more.
Great. Thank you.
Thanks, Jess.